All right, let's jump right into this explainer. Today, we're unpacking a deeply held financial belief that millions of us rely on without question: the absolute, untouchable safety of fixed deposits.
Take a second and think about your own bank balance right now. Ask yourself, is your money actually as protected as you think it is? We treat fixed deposits like the ultimate financial fortress, but, well, what if that safety net has a few hidden holes in it?
We can call this the Great Indian Comfort Zone. You know that warm, fuzzy feeling of seeing your hard-earned cash safely locked away in a traditional bank FD? It feels rock solid. But today, we're pulling out the magnifying glass and reading the fine print. We need to see if that blind trust actually holds up against the raw math.
So, let's hit our first big misconception. Myth number 1, my money is growing, also known as the purchasing power leak. Imagine you have 1 lakh rupees today. At a standard 5% inflation rate, in 10 years, that exact same amount will only have the purchasing power of about 61,000 rupees. That is a massive, silent loss of nearly 39% in real value. It's like a leaky bucket. Even if your bank balance looks exactly the same on paper, you're literally getting poorer over time.
See, there's a huge difference between what you see and what you actually get. You've got the nominal return. That's the flashy headline rate your bank advertises. Looks great, right? But then there's the real return. That's what is actually left over after inflation takes its bite. If you aren't looking at the real return, you're basically flying blind.
Let's run some actual numbers here. Say you're in the 30% tax bracket, and you're getting a 7% nominal FD rate. Right off the bat, the tax man takes his cut, dropping your return down to 4.9%. Now stack that up against a conservative inflation rate of 5%. This isn't theoretical. This brutal math is happening to your savings right now.
And here is the punchline: minus 0.1%. It's a shocking negative real return. You are actively losing purchasing power even with what everyone would call a good FD rate. Sure, your money's technically sitting safe and sound in an account, but its actual ability to buy things in the real world, it's shrinking every single day.
All right, moving on to myth number 2. Big banks protect all my money, or what we can call the structural illusion.
We're naturally wired to trust massive familiar banking brands, right? Those huge commercial banks. We tend to pick them over smaller institutions like small finance banks, or SFBs, because we just assume that a bigger size equals absolute bulletproof safety for our deposits. Big brand, big comfort. But actually, the official banking rules tell a totally different story.
Here's the reality check. The actual safety net for your money is provided by the DICG, and their rule is absolutely black and white. The insurance limit is exactly 5 lakh rupees, period. That applies per depositor, per bank, and, this is absolutely crucial, it includes both your principal amount and your accrued interest. The safety net stops at 5 lakh no matter how giant or famous the bank logo is.
So, what does that actually mean for you? Well, if you drop a 7 lakh rupee deposit into one single bank, 2 lakh rupees of your hard-earned money is completely uninsured, is totally exposed. If you park a large lump sum in one place, anything above that 5 lakh mark, including the interest it earns, is sitting out in the open, vulnerable.
Which brings us to a really scary hidden risk. What on earth happens if your bank faces a moratorium? A lot of us treat our FD like a perfectly liquid emergency fund, right? Ready to break in case of an emergency. But what if the bank itself runs into regulatory trouble?
You fall right into what's called a liquidity trap. A regulatory moratorium can completely freeze your withdrawals. On top of that, your interest might just stop accruing entirely. And those DICGC insurance payouts, they can be seriously delayed. So even if your money is technically under the 5 lakh limit, a regulatory freeze traps your funds. It proves that an FD isn't always the perfectly liquid safety net you might need when things go south.
Okay, part 3, the reality check. Structuring your safety net.
Let's look at some current rates. For a 1 to 2 year tenure, small finance banks are offering around 7.1%, while large banks are at 6.4%. That's a solid 0.7% premium. For a 3 to 5 year stretch, you're looking at a 0.5% premium. Why? Well, SFBs just don't have the massive brand recognition of the mega banks, so they offer better rates to attract your deposits.
Now, I know what you're thinking. Higher rate means higher risk, right? Actually, scratch that. No. The higher rate isn't a red flag at all. It's literally just a market positioning strategy.
SFBs are heavily regulated by the RBI, and they fall under the exact same 5 lakh DICGC insurance framework, so your money gets the exact same level of regulatory protection as it would sitting in a giant commercial bank.
So how do we actually play this to our advantage? It's all about how you structure things. Step 1, break your deposits into chunks of no more than 4 to 4.5 lakh rupees. Step 2, spread those chunks across multiple different banks, including those higher-yielding SFBs. By keeping each chunk under 4.5 lakh, you guarantee that your principal plus the future interest will stay fully insured underneath that 5 lakh cap at every single bank.
And what does this little structural tweak actually get you? An extra 9,600 rupees simply by moving a 4 lakh deposit from a 6.5% rate at a big bank over to a 7.2% rate at an SFB. You pocket an extra 9,600 rupees over 3 years. And the kicker? Because you structured it smartly, every single rupee of that remains 100% insured.
We've gone through some pretty eye-opening math today, so I want to leave you with this one question to chew on. Is your safety net actually designed to catch you? Take a hard look at how your savings are structured right now. Run the numbers against inflation and check your limits. Are you truly protected by the rules, or are you just caught up in a comfortable illusion?